They just did it. The Federal Reserve finally lowered its interest rate. Not a huge shift, only 25 basis points. But that tiny move hides a much larger story. A surrender of priorities, a gamble with consequences. Because now they're telling us more cuts are coming. And that means something very big has changed about how Washington thinks about inflation, jobs, and risk. Today we peel back what this meeting really means. Not the press release wording, the dot plots, the reassuring speeches, but what's underneath. Because there's a crisis brewing in America. Inflation is not dead. The labor market is weakening. And the Fed, nervous, is about to double down on ease. Here are the facts. They cut rates last week by 25 basis points. Expected, yes. Predictable, perhaps. What wasn't expected, in their projections, they're signaling two more cuts before the year is out. October, then December. Bold, aggressive, risky. What else did they reveal? GDP growth has been revised upwards slightly, 1.6% instead of 1.4%. But unemployment, they expect 4.5% by year's end. We're at about 4.3% now. So they're planning for weakness, job losses baked into the forecast because they believe labor is softening. Inflation, especially their preferred measure, the PCE, personal consumption expenditures. They expect around 3% by year's end. Core inflation, excluding volatile food and energy, they expect about 3.1%. Not good. That's clearly above their 2% target. So yes, more inflation, and importantly, inflation that they believe will accelerate before any decent easing. Jerome Powell was clear. Inflation is bad, but what keeps them up at night now is labor market weakness. Unemployment creeping up, trouble for youth, recent graduates, specific demographics. He called this move a risk management cut. That's Washington speak for. Inflation is dangerous, but job losses are even more dangerous politically, socially. He also said, we are data dependent, meeting by meeting. If things worsen, adjust. If they improve, maybe cut slow. But note, there was dissent. The newly confirmed Fed Governor Stephen Miron wanted a larger 50 basis point cut, but lost that vote. That tells you there are hawks and doves inside pressure from multiple directions. What are people, markets, forums, analysts saying? On Wall Street, cautious optimism. Some relief, but many skeptical. Inflation feels sticky. Some believe the cuts are already priced in. Others warn that this balancing act could collapse. On Reddit, X, investing forums, the narrative is shifting. Among retail investors, there's excitement. Finally, the Fed is paying attention to Main Street. But also fear. Fear that inflation will surge if they ease too quickly. Fear of bubbles in housing, in equities. Other signals, inflation data remains stubborn. Consumer spending is cooling. Growth is half the pace it was a year ago. Many economists are pointing out that while inflation remains stubborn, the labor side is showing cracks. Job gains are slowing, unemployment creeping. So here's where the narrative forks. Because a path of aggressive rate cuts, while politically attractive, market friendly, is a high stake game. And it could blow up. Let's consider consequences if the Fed follows through with these cuts. First, inflation will almost certainly stay too high longer. They're explicitly forecasting core inflation above 3%. That's a problem because inflation is not uniform. Food, shelter, medical costs, rent, they hit the poor and middle class hardest. Wages do not keep up. Real income declines. Second, asset bubbles. Risky assets love cheap money. If rates fall, credit gets cheaper, housing, real estate speculation, carry trades all become more attractive. Stocks may keep climbing, but what if there is a correction or inflation surprises? Then the hangover could be severe. Third, government, corporate, and individual debt. Some will benefit, those refinancing floating rate debt. Others lose. Those locked in or leveraged badly could suffer. Interest rate expectations get messy. Fourth, Fed credibility. They keep pointing to a 2% inflation target, but they also keep moving the timeline out, sometimes 2028 or beyond. If inflation refuses to fall or falls too slowly, trusting the Fed becomes hard. What happens when the markets stop believing what they say? Fifth, political risk. This is not academic. Decisions about rate cuts help asset holders, Wall Street types, big corporations. But what burdens fall on wage earners, on renters, on fixed income, on people who depend on stable prices? That may fuel discontent. Already political pressure from Trump's appointees is evident. On the flip side, why the Fed might get it right, or at least avoid disaster. They're cautious. Powell's insistence on data dependence provides some guardrails. If upcoming inflation reports show accelerating shelter or service inflation, they might pause. If labor data holds up, they can claim the cuts helped. Some parts of inflation are cooling, not uniformly. Some components, goods, energy, less volatile. But core services, shelter, wages are proving stubborn. If those moderate, things might stabilize. And labor market weakness is real. Job growth slowing. Unemployment creeping. That is costly socially and also politically. The Fed may view it as the greatest risk right now. The fear of recession may seem acceptable compared to runaway inflation, or at least easier to manage in political narrative. But here's what I believe is really going on, what they are not telling you. There's a deeper tension. The Fed is being squeezed politically from markets, from financial stability concerns. Trump is pushing for aggressive cuts. Some on the Fed board align, others are resisting. Meanwhile, inflation remains alive, and public confidence in the Fed's control is fragile. They are trying to thread a very thin needle. Avoid recession, avoid runaway inflation, avoid market panic. But in this tension, overshoot is probable. They will cut too fast, too soon, believing inflation will behave, or believing that mild inflation is tolerable if unemployment rises. But that's a dangerous assumption. If inflation remains sticky in shelter, healthcare, services, they may be forced to hike again next year. And those reversals hurt. Markets hate reverse swings. Credibility gets damaged, volatility follows, ordinary people pay. What should you watch for the incoming weeks and months? 1. October meeting. If they repeat the 25 basis point cut and double down with signals for more, the path is set. If not, maybe they pause. That will tell us whether they believe inflation risk has receded or whether they're already locked in. 2. Inflation reports, especially core inflation, shelter, healthcare, services. If those keep accelerating, that's bad. If they moderate, that's the best hope. 3. Labor data. Not just the headline unemployment rate, but demographics, youth unemployment, recent grads, marginalized communities, job creation, job cuts. That will test Fed assumptions. 4. Market reactions. Watch equities, housing, real estate credit spreads, bond yields. Are people betting bubbles? Are credit spreads narrowing dangerously? Are long-term yields rising despite cuts? Excuse me. Here's the bottom line. This is a significant shift. The expectation isn't just lower rates at some point. It's aggressive cuts now. That means inflation, long demon in the room, is now in the Fed's view, the lesser danger. They believe job loss, economic softness, social instability are worse threats. That's a gamble. It might work if inflation cooperates, if global shocks don't come, if labor weakness doesn't morph into mass pain. But if it doesn't, the blowback may be brutal. And it'll be those least able to absorb it who suffer the worst. Because in the end, economic policy is political policy. Choices make winners and losers. We need to see not just what they say, but what they do, and how it hits ordinary people. If you found this useful, share it. If you want deep dives on sectors likely to explode under the strategy, housing, finance, commodities, I can do those too. So don't forget to like this video, subscribe, and hit that bell button so you never miss an update. Your support lets me keep bringing you more content just like this. I'll see you next time. Bye-bye.